Good morning. Today is Thursday, December 8th, 2022. Man, we're down to it. 23 days left in the year, 3 weeks. So get your Christmas shopping in now because we are seeing some delays, at least anecdotally. I know I'm seeing some delays. Tom's seeing some delays, causing a bit of stress considering our office Christmas party is, well, I guess we're having 2 Christmas parties, but the gift exchange is the following next Friday. So Walmart CEO Doug McMillon was talking about, consumer spending yesterday, and he said really 4 things. Number one, inflation remains an issue. He says that dry grocery and consumables still has mid double digit inflation if that feels stubborn. So this is your Procter & Gamble products, your paper products, your cereals, your chips. That's all up about 15%. That's not coming down. He says that higher income people are still shopping at Walmart, but they're mostly shopping in the grocery aisle. So they're really looking for the deals. Walmart wants to upgrade them into shopping throughout the rest of the store. And he does say that the penny pinching has started to spread from lower incomes. And he says that general merchandise sales really started dropping off, and that pressure played through to higher income levels as the months went by. So you can see behavioral change now basically at all income levels in the country as people become more price sensitive on those discretionary items. And he says that at the end of the day, the Christmas spending numbers are going to look good. But the reason they're going to look good is because of inflation. And he says, and I quote, "If you look at a top line point of view, we'll look better because of inflated dollars than it actually is. If you look at units and kind of quality of the breadth of what sells at retail, as a retailer, we won't feel great about the quality of this Christmas." So a bad quality Christmas from Walmart. Tom, does the Fed listen to any of this? And do you think this has consequence as it relates to the overall economic backdrop?
I mean, I think it rings true that we're seeing stickier inflation. I think that it's not something they look at directly. I don't think they consider dry consumables, dry grocery, things like that to be part of really their analysis. But I think it's something to keep an eye on, particularly as it relates to the actual individual person and markets in general. And I think there's a great point there, in terms of the top line's going to look awesome because of inflation. Because if you sell 10 TVs for $100 in 2021, but then you sell the same 10 TVs for $150 the next year, sure, you made more money, but you sold the same number of TVs. So it's not really growth, or at least I would call organic growth. So we need to be really careful with some of these companies that are coming out with numbers that look really good. I mean, maybe Best Buy is a great example from a couple of weeks ago where, Target really took it on the chin, but Best Buy looked awesome, because a lot of people bought TVs at Best Buy, but did they move more TVs or do they just have more expensive TVs and people went there because they specifically sell TVs? I think that's really how we need to sort of like mine for gold or pan for gold in the situation, shake out all the dirt, figure out what exactly we're looking at with some of these companies.
Jobless claims are out, 230,000, it looks like, roughly in line with expectations, roughly in line with last week. So again, we see all this anecdotal evidence of these layoffs taking place, but we're not really seeing that in the big headline numbers just at this point. And Walgreens CEO was out at a conference earlier this week, and she basically said, look, her name's Roz Brewer. She used to be the CFO, I believe, at Starbucks. And she came out and said, look, we love it when we hear these announcements of layoffs because we're able to hire these people. And so we're just hiring all the people that we can get. So, for every loser, there's a winner. And it seems like that's how the jobs market is shaking out right now, which means that on net, you're not really seeing all that much in terms of unemployment going up.
Yeah, I mean, even if you look at layoffs, that FYI, which is the tech startup website that we referenced a couple times in macro presentations, I mean, you see unbelievable numbers there, but it doesn't seem to filter through. I mean, if you look at, the first 8 days of December was already worse layoff month for tech than January, February, March, and April, and yet you're not seeing that filter through to the initial jobless claims. So those people are getting picked up somewhere, or they're, suppose they've made enough money that they're not filing for unemployment right away, but there are layoffs occurring. It just doesn't seem to feed through to these big national numbers that get, put out by the Bureau of Labor Statistics or ADP. So, there's a little bit of a divergence there, but maybe it's just the beginning. The cracks are just in the tech space.
Interesting story. Again, sticking in central banks, the ECB, the European Central Bank, the staff. So these banks have the policymakers and decision makers, and they also have staff. In the U.S., we have about 1,000 staff at the Federal Reserve, similar in Europe. The staffers in Europe, the people who actually number crunch and analyze policy, they are preparing to strike. And the reason they're preparing to strike is because they've been offered a pay raise of 4.07%. They say this isn't even close to inflation. We're going to strike if you don't raise our pay by more than 4%. So, I mean, you're talking about, it seems like they want something 7% plus, because, if they were 5 or 6%, you could compromise at 4. So they're probably at 7-8% in terms of the pay raises that they want. And then at the same time, these central bankers are looking you dead in the eye, and they're saying, we don't see any wage price pressure. What gives?
Theoretically, if you wanted a 5% raise, you'd have to get 10 or 15% because you'd have to get 5% over inflation to really make any noticeable needle moving changes in terms of your income. So, I still think that's going to be a piece that's going to be much harder for the central banks to stamp out. People aren't going to walk into a meeting and accept a 3% raise anymore because inflation is 1%. Like, you need meaningful change in order for it to really be a raise, and this is not going to be up to snuff.
Yeah, I agree. Oil. Let's talk a little bit about oil. We had inventories come out yesterday. Inventories were very light. We had a big draw, 5.2 million barrels drawn in the U.S. Again, that's distinct from the Strategic Petroleum Reserve. This is just how much oil is sitting stored in various containers in the U.S. It was a little bit better than the prior week, where we drew about 13 million barrels in a single week, which was the biggest number I'd ever seen. But still, 5.2 million barrels, that's a lot of barrels for a week. So that's almost an average of 1 million per day, which is about 10% of the U.S. consumption. So it does seem like refiners are increasing their utilization. We're seeing a little bit more production of gasoline. We're seeing more production of distillates, which we desperately needed because we were running very short on diesel there for a while. So that's good. But now you have the flip side of it, lower oil. On top of that, about 20 minutes ago, we had news that the Keystone pipeline just went out. There was a leak in Nebraska, so that's done. That transports 600,000 barrels a day. Again, of the U.S.'s 12 million barrels or so of production. So you're talking about 5% hit there. So, and yet oil prices continue to be downwardly mobile because of this overarching demand side. I think there are a couple of reasons for the oil weakness. Number one is just lower demand expectations in general. You've seen a little bit of a coming down of the curve. But number two, and probably more importantly, is you have a near-term supply glut. I think the Russian government really loaded the boats literally with oil ahead of this price cap that Europe imposed. So I think that you have a little bit of a near-term glut on oil, not in the U.S. yet, as you're seeing these big draws, but globally, I think you're seeing a little bit of a draw. Tom, any thoughts on oil going forward?
Yeah, in your opinion, you think that's an opportunity rather than a risk? This is time to be accumulating oil stocks again in anticipation of that supply getting sucked out of the system? Call it Q1. I
think it's time to, you always say this, zig when others are zagging. And at the same time, you don't want to bet the farm on it, because you are going a bit against the tide. But the thing is, if you go a little bit against the tide right before the tide turns, then you get that nice early boost. The way that this market has deteriorated in terms of the technical indicators, and oil is a technical market, just like currencies. It's a little bit different than stocks, less fundamentally driven on the near-term basis. There's been a lot of technical breakdown that I think will take some time to rediscover. But I would say, I was talking to a couple interns actually yesterday about this. And they were saying, well, oil stocks have really got down. A week and a half ago, ExxonMobil was 113. Now it's 102. It's like, that's nothing.
ExxonMobil was $45 a year ago.
That's not a decline at all. If you're talking about oil prices that went from $90 to $70. So usually you see greater magnitudes of moves from the oil and gas companies. And you're not seeing that right now, which suggests to me that the market is looking through this already. And so maybe the upside in the oil and gas company, you might see oil go down, oil go up, and a lower beta to some of the actual oil and gas stocks relative to oil.
Yeah, I think that's an interesting analysis. It's not only sometimes zigging when others zagging is good, but also second level thinking is the most important thing, to quote Howard Marks.
Yeah. All right, let's talk about the Teamsters pension fund bailout. This is a story that I confess I was not following very closely. The Teamsters union basically got itself into a big jam. They didn't have they're claiming that they don't have the money to pay their pension. And so the Biden administration is going to hand out $36 billion to the Central States Pension Fund to shore up the pension for this labor union, which again, it's not a federally mandated union. It's not federally affiliated. They're getting $36 billion. He's going to make the announcement today. He's going to be joined by Teamsters President Sean O'Brien, AFL-CIO President Liz Schiller, and Labor Secretary Marty Walsh. Basically, what he's trying to do is regain some favor with the unions after the railroad issue last week. He's doing it under the auspices of the American Rescue Plan, which was passed in March 2021. This is the one that had that stimulus check, that last set of stimulus checks that we got. I don't know. What are your thoughts, Tom?
I think it's probably in his best interest because the two notable people who went against the Teamsters, Jimmy Hoffa and John F. Kennedy, one of them disappeared and the other one ended up with a bullet in his head. So just food for thought with the Teamsters. That being said, I mean, we're handing out money to a lot of people, and I think this is a little bit of a makeup call for Biden in terms of the railroad union. You know, he basically had to go against the unions, force them to take a deal that they didn't want, and how does he make up that call? Well, he turns around and gives money to a different union in order to make sure they can satisfy their pension. And I think that's a little bit of what's going on here. It's a little bit of, robbing Peter to pay Paul. But, honestly, if we're going to be handing out money, I'd rather give $36 billion to the Teamsters than, $105.5 billion to a country overseas that none of us have ever been to. If we're just going to be spending money, we might as well spend it here. Is sort of the opinion I'm of, but it's not great just to be throwing money around like that.
And it creates a moral hazard too. I mean, if the Teamsters have failed to plan and failed to invest properly and failed to have good risk controls, which if you need a bailout, something got screwed up. I mean, the market's down 10% this year.
Well, the risk controls,
you should not have pensions that are blowing up. Like, this is an error on the Teamsters, and it's just here you go.
I mean, I would arguably blame the Fed. The risk controls in pensions. So if you think about how we operate with asset allocations, is that we sit down with a client and say, in order to make sure we meet your goals and to assume that you're taking the amount of risk you want to take, we set parameters, right, for everybody. We want to be 60-40 or 70-30. You're mandated as a pension to have a certain level of exposure. You have to have so many bonds, and for 20 years, since 2008, or at least zero interest rate policy, you've had to have all these bonds and not paying anything. In order to get the yield you need to pay out, you got to take on either more credit risk or more duration risk. We smash cut to now, the Fed's raising interest rate. Well, what happens to these high interest rate risky assets that you've got in your pension? Well, they're getting crushed. And not only that, but now you're behind where everybody else is getting paid 4% to be in treasuries. You've got these bonds that are paying 1% and you're stuck in them for 20 years and they're down 80%. And so to a certain extent, the mandatory risk controls actually made the whole situation riskier, because in theory, if you really wanted to achieve those goals, you would have moved out of most of that fixed income and into equities when equities were hot. And then when equities started to slow down, you're selling and you're buying back into these bonds, which is sort of the way we try and operate with portfolios, even within the parameters of the investment policy statement. But they basically are mandated. They have to have this much because this much is quote unquote safe. But in this environment, your interest rate make those assets very risky in terms of capital loss. And so that's the situation they're in. It happened with it happens with a lot of pensions. You've seen it. I mean, Delta's a great example. When they went bankrupt, they couldn't fund their pension. A lot of companies, Lockheed got, I think, $11 billion during COVID because they couldn't fund their pension. This is what we're seeing. It's a function almost of the risk controls that causes this to happen. They make it so you have to take risk in the quote unquote riskless assets, which can get just as beat up if you're in the wrong scenario.
And I mean, that's a great point. I mean, they were modeling with 4 or 5% returns in fixed income. When bonds were yielding 1%, you couldn't hit that. And so what they should have done is said, okay, well, our prospective returns are going to be 3 or 4%, and raise a little bit more money, raise dues as a result. And they didn't do that. They didn't match. It's called asset liability mismatch. You have assets, which are your bonds that are supposed to pay. And when those bonds pay, you pay the pension. It's just a cash flow that comes in one end and out the other. The problem is if you don't have the adequate cash flows coming in, or you're hoping for something else that's going to happen, that's when you have that asset. And I think at the end of the day, it seems to me, and I don't really want to get political here, but you're really subsidizing a flawed mechanism, and what you're doing is you're hiding the fact that these unions don't work.
Yeah.
I mean, if I had to guess.
Yeah. Listen, my dad was a union guy. He was in the Airline Pilots Association, and he worked for 30 years. And at the end of the day, when the time he got his pension, Delta went bankrupt, and they said, sorry, man. And he went bankrupt. And it sucked, man. It derailed my career, derailed my whole operation as a 18, 19-year-old kid. I was suddenly, my parents had nothing, and it sucks. And the unions are insidious in that way, because the people who are in them, who work for them, they're just working people. It's a lot of the people at the top who manage that money. They walk away and they don't think about it, but it affects people. It affected me personally, and it sucks, man.
All right, we're gonna end on
a terrible note.
We're gonna end on a more positive note, and we're gonna do a little bit of Tom. Do you want to take Prasant or do you want to take Blaine? And we'll just go through this. This is a conversation from yesterday between Analog Devices CFO and the Barclays analyst. Barclays invited the Analog Devices to their conference yesterday, and then 3 days later, after the Analog Devices accepted the invitation to speak at the conference, Barclays downgraded the stock to equal weight. It's safe to say ADI's CFO was not happy. So I'll take Prasant, and if you want to take Blaine.
Yeah, that works.
All right. So he starts off. Yeah, great. I do want to congratulate you, Blaine. We got the request from you to come out for your conference. Mike and I said, oh, we got to support Blaine. We got to figure out how to make this work. So we were actually out here for some other meetings. We Ubered up here really for 2 hours to take care of this for you. And about 3 days after we agreed to come out here, you downgraded us. So well done.
Not ideal.
All right. So as you said, we've reported.
He's like, you're the bigger man.
So as you said, yeah, our fiscal year ends in October, et cetera, et cetera. So I don't know. It was maybe it doesn't come across in the speaking, but
our electric role play there.
But it was a very testy exchange, and this is just some of the stuff with analysts and CFOs. They don't always get along. So
I do love that he went right at him, though.
Yeah,
and that's a pretty low blow to invite a CEO to your CFO. Is he CFO?
CFO.
Yeah, CFO to your conference to speak under the auspices of it. As soon as he does it, you're going to ding the stock.
Yep.
But I do love that at least he went right after him. I mean, that's fair play.
Yeah. That's what makes a market. So tonight we have Lululemon, Costco. We'll talk about that tomorrow morning. Have a great day. We'll see you tomorrow.